Welcome back. Shares of ServiceNow moving down, as you see, a bit this morning, despite what were numbers reported after the bell that were better than many of the analysts, at least the commentary I've seen this morning, who follow the company, had anticipated. Let's bring in Bill McDermott, the company's CEO, to discuss it in more detail. Bill, always good to have you. I want to start off on something actually that might be pressuring the stock, and it's not related to your numbers, but to your head of sales and a planned departure. It was noted in the call, sort of halfway through the call, but it did seem to take some investors by surprise, and I wondered if you could just discuss it in light of the fact that it may be pressuring your shares.
Right. And, yeah, as you know, any change to the capital markets raises questions, right? So David Schneider is a 35-year sales veteran, has been with the company for 9 years, had a great career. The first day I met him last year, he said he's going to retire at the end of 2020. So Kevin Haverty has been running the number and leading sales for us for 6 years. So there really is no change, and David's staying with me till the end of the year. And we have an outstanding management team. There's no fundamental change to the coverage model, who's running the number, and the execution with customers. So they need not worry. We're good.
All right. So you're good, and there's nothing more to say about it at this point then, Bill. Is that right?
Absolutely. Absolutely not, other than congratulations to Dave for having a great career. And he's going to spend some time with his family, and after 35 years, he's earned that. But ServiceNow pipeline, performance, outperformance, we are ready to roll.
Bill, Jim Cramer, good to see you, partner. How you been?
Hey, Jane. How are you, Jim?
I miss you. I miss you in the East. Miss your conference. But there's no conferences going on
we'll
anyway.
Be back.
I full disclose, I know it's not about friends, about money, but I know Bill outside the office. Bill, I'm going to give you a choice. You can talk about what you did for Goldman Sachs, or you can talk about what you did for Disney and Disney Plus, so people understand how you have a great return on investment when somebody brings you in.
Yeah, Jim, thank you for the question. So if we've learned anything, especially from this COVID environment, every CEO wants to give their employees a great experience. And if you think about that experience, we have to make work better for people. People deserve in the enterprise to have the same consumer-grade experience as they enjoy on their living room couch on a Saturday afternoon. So if you think about what we've done for the employee experience, take a JP Morgan, take a Goldman Sachs, take an Uber. We're streamlining the employee experience. Everything is mobile. Everything is web-based. Everything is connected to conversational tools like Teams and Zoom. So that experience has to be world-class. Also, we now have a return to workplace application suite where we keep people safe. Are they ready to come back? Is testing in place? Is social distancing in place? PPE inventory management. We took Uber and brought them live in less than 2 weeks on our whole return to workplace suite of applications. So employee experience really key. Now, you mentioned another paradigm, which is Disney. And this is the customer service management paradigm, Jim. How do we take business models and completely reinvent them, right? So Disney, no theme park, no cinema, not much on ESPN. Let's go for Disney Plus. We got them with 55 million users now, signing up for subscriptions, using virtual agents and AI to make sure the experience is great. And if it's not, a human is automatically issued a workflow to make sure the customer is happy. And Zoom, 300 million users. Can you imagine this volume? And we're managing that for Zoom to make sure the customers for Zoom are happy. So that's what we're doing, Jim. We're making work better for people.
All right, so the street's thinking, some people feel that the billings, your guidance, was a little bit light. I don't know. I mean, to me, this is a tough environment. You did so many million plus $1 million sales. But I just want to hear your view about whether you think things are going to get worse or it's difficult to predict because the stock is down. I'm trying to get my arms around that.
Yeah. So first of all, think about this, Jim. You're in a situation where you have a beat on revenue, on margin, on free cash flow. So everything and also on the billings, everything in the company is a beat. So in Q3, we have seasonality where in the third quarter, more deals are starting to happen, and this is a year-over-year paradigm with ServiceNow, in Q2 and Q4. So seasonally, Q3 has a little bit less bookings than Q2 and Q4. So We raised the full year guidance. We reiterated that the billings are fine, and you'll get back into the 20s in billing for the full year, and that's the way we guided the company. So you're solid on revenue, you're solid on billings, solid on free cash flow margin and operating margin in the company. This company is ready to outperform yet again in the second half. That's why we raised the full year guidance with total confidence.